in late 2021, and kind of what we saw there was a missing link to bring investors from the different asset classes to circle around and come together and focus on what's going on in Indiana and what's going to continue to make Indiana a success story relative to the rest of the country. Because you have CFA Society, which is more public markets, ACG, like private equity, you get the gist. And so we're trying to really center this around highlighting the great talent and ideas that are coming out of this state. And that's kind of where the Hoosier Hub is. So with that, just wanted to kind of go through some of our upcoming events. So we'll kick it off here. Sam, who's leading our March event, is going to talk a little bit more about that.
Real quick question, are there any HR people in the room?
Kind of.
Kind of. All right, cover your ears. Cover your ears. Who here is under 40? Okay, that means you guys just found out what a bond is like 2 months ago. It's great. I just bought a U.S. Treasury for 5%. Never thought, I didn't know that was possible. But our March event is around the author of The Bond King, Mary Child. She's coming in giving a talk. She also hosts Planet Money. So if you want to learn about bonds, her experience in finance, she's a great personality. She's going to be there March 9th at Vallejo's headquarters at 6 o'clock. So love to have you.
Thanks, Sam. And then I wanted to kind of talk about our biggest event of the year that we've got lined up for May. Again, off the success of last year. The opening day of practice of the Indianapolis 500 at IMS. We're going to have the annual investment forum. And we're doing the lineup even bigger this year, and I mean like super big. Names we've got Joe Dowling from Blackstone. We have Karen, I'll butcher her last name, so I won't say it, but the co-CIO of Bridgewater, the largest hedge fund in the world. We have a great lineup of private equity managing partners from HKW, Centerfield, Heritage Group, and there might be some high-level politicians to be here as well. And we're right now kind of confirming the rest of the day, but it's going to be a huge lineup. You're not going to want to miss it. We actually have some, let's see here, we got some registrations here. We'll bring this up at the end if you guys want to register, but like I said, we love just seeing the turnout of these events. We've gone from a lot of luncheons where people came and ate and left, and now we're building a community where people are coming and talking and building friendships and building business ideas and things like that. So we love to see it. But with that, we can't do that without support. And the support is coming from all over now. And if you look over here, our sustaining sponsors, Bloomberg, Harvard Capital Advisors, Invesco, Macquarie, and Proteus. These guys help us put on these events financially and allow the cheap prices. Well, and then so you cut me off because we got the local firm members, and the local firm members are even bigger supporters of the organization. We got Barnes & Thornburg, Reams Asset Management, my own firm, Vallejo Advisors. So what we're doing is we're trying to build this community, and we need everyone to support. And so we're just extremely appreciative of everyone that's been able to help do this, because you can't put on big events like we've been doing without the financial resources. So thank you so much for everyone that has supported us. So with that, I'll turn it over to Chris, who's going to kind of kick off this event and talk about this great topic we got going on. Thank you.
Thanks, Gary. I'm Chris Reckley. I'm the committee chair of the Hoosier Hub. So as you can see, over the last 2 years, we've been really fortunate since we brought the Hoosier Hub out to have some great events: venture capital, ESG investing, real estate. If you guys came to that at PAC 9, you might have just seen in the IBJ the announcement from the Indy 11 Park. We kind of broke that, not really, but in a way. And so, all centered around local, alternative type investments. Again, the VCs, the PE, the real estate. And so we've been really fortunate to have a lot of great speakers. That doesn't stop tonight, that continues. I'll keep this really quick, but I'll introduce Jason Brown of Proteus and Dave Hooper of Barnes & Thornburg, and I'll let them run
All right, thanks so much. And there you go. Give him a hand. He doesn't get enough applause. So. And for the fellow that was just up here talking about bond investing, don't pat yourself on the back too much. 5%, you can still get I bonds for 6.5%. So just be careful about that. But again, my name's Dave Hooper. I'm a partner here at Barnes & Thornburg, the chair of our Securities and Capital Markets practice group. And I want to start off these discussions, as I always do, giving a big thanks to the CFA Society, Hoosier Hub, attorney here in our office in Barnes, Thomas Lyons, for all he does for everything, Jared and all his team. So just a huge round of thanks, and just give them a round of applause. They really do a great job bringing people together. So with that, I want to jump right in and introduce Jason Brown, who's the founder and CEO of Proteus, and who I've known for a long time now, both professionally and personally. So long, in fact, that when we first met, both of us had jet black hair. So for all you young people out there, this is what you have to look forward to, okay? But in all seriousness, Jason's been an extremely effective and important executive and entrepreneur and investment manager, both here in the Indianapolis area and nationwide for a long time. He also co-founded Archway Technology Partners almost a couple decades ago, and was able to accomplish a terrific exit in 2017 for Archway. So Jason and his team, including Eric Knaus, the president and CIO of Proteus, is here today as well and will be on the next panel. So they've just been a staple. Jason has been a staple in the investment management and alt investment space, family office space for many years. So we're thrilled to have Jason.
Yeah, and as an aside, when we first met Dave, I believe his billing rate was about $75 an hour. I can assure you it's no longer that.
But like I just told him, our rates are going up slower than the rate of inflation, so everything's relative. But what we want to do in this segment is what I always like to do in these forums, and that is to focus on the trends, the significant business aspects, and the outlook in the industry that we're talking about, and specifically today, the alternative investment industry, and how they're structured and operated, and how investors can take advantage of the alternative investment space that we're talking about, no matter what the macroeconomic environment is. So when we're talking about alt investments, just a quick primer. I know most of you probably already know most or all this, but just as a background, a backdrop, before we get into kind of the specific meat, an alternative asset is a financial asset that doesn't fall into the conventional investment categories, such as publicly traded equities, bonds, cash instruments, cash equivalents. Alternative investments can include private equity, venture capital, hedge funds, commodities, derivatives, real estate and real estate linked, real estate related assets, and yes, even now, crypto and crypto related assets. So when you think of alternative investments, you typically think of investments in private investment fund vehicles that are structured as either limited partnerships or limited liability companies or certain types of business trusts, hedge funds, private equity funds, venture capital, real estate equity funds, and again, derivatives and commodities. They're typically invested in by institutional investors, high net worth individuals that meet the accredited investor and most of the time the qualified purchaser definitions that you see in the federal securities laws. And they're fairly illiquid. Alternative investments, there can be liquid investments in the alt space, but compared to publicly traded equities, they're fairly illiquid from that perspective. And in years past, alts were characterized, in addition to everything I just talked about, they were characterized by something of I wouldn't call it a lax regulatory environment, but one in which there just wasn't nearly as much regulation applicable to the alternative investments as there is now. That's changed quite a bit with the advent of the Dodd-Frank Act, almost 15 years ago now. And so it's a much higher regulated environment than it used to be in decades past. But at their core, alt investments are focused on generating superior returns compared to the typical, more run-of-the-mill investments that I referred to before, but in a non-correlated fashion, not necessarily correlated to the returns that you're seeing in the S&P 500, Russell 3000 for smaller companies, or the Dow Jones Industrial Average. So in this way, at their core, alts can reduce or mitigate your commercial or financial risk as an investor from the investor's standpoint, which in much way it introduces the term hedge fund in the alternative investment space. So that's a perfect segue to bring Jason in here and kind of get into some of our core questions that we wanted to talk about. And Jason, I'll just start off, alt investing has thrived for many, many decades. It's survived some pretty bad downturns. It survived the financial crisis, many different business cycles over the years. And we all know that the current business cycle is very, very challenging for many different allocators and investors. We have stagnant growth. We have a probable recession, again, coming up towards the end of this year. We'll see what happens. And then we've also seen demand destruction caused by the rate environment that we're in. How can investors and allocators use alt investing to their benefit in this environment? Are there trends you're seeing in asset allocation on the alt side that could benefit in this environment? What do you think?
Yeah, so first of all, Paul Francis, can I get a sound check? Can you hear me okay? All right, good. So it's a fantastic question. There's a lot of headlines out there about flows of assets into illiquid. Some of them date back even a year or so, starts feeling like a lifetime ago, and whether or not those trends still apply to today. I think it's helpful to go back and talk about why there was such a growth and explosion in alternative assets to begin with. All this really started decades ago with pensions needing to meet obligations and a dramatic difference between interest rates compared with the expected return of their portfolios. That was what really drove assets into the alternative investment space. As we've seen rates come up, and I believe the 10-year rate now is maybe a little under 4 or so, there's still a pretty dramatic difference between an expected return of an institutional portfolio compared with what just interest-bearing instruments can produce. Now, while that gap has been significantly reduced over the last, probably even 6-9 months or so, there's still a pretty significant gap, which means there's still going to be a place for growth in portfolios, and in particular, the private space. So when we look at those dynamics and we say if it was interest rates alone, we have reduced the gap between interest rates and expected rate of returns. You would say on that variable alone, should we expect flows into illiquid private assets start to reduce, slow down, or even see some outflows out of these types of products? There's another dynamic that's occurred, which also we've seen in a lot of headlines as of late, which is the shift of capital formation from the public markets to the private markets. There's a fantastic, I think it was the Thinking Ahead Institute had published just a couple of real high-level bullet points looking at Google, Facebook, and Uber and their IPOs. Google, which was, I believe, 2004, so close to say 20 years ago or so, the public to private ratio of capital formation in Google was 76. That means for every $1 of private capital that went into working capital for growth at Google, $76 from the public market went into that business. That means that, I can't do that math off the top of my head, but 1.5% or 1.25% or so of the growth of that business went to the private markets. All the other returns and value went to public markets. Facebook happened sometime around 2012, I believe, if I'm not mistaken. That public to private ratio was 7.6. So for every dollar of the private market capital that went into working capital to grow Facebook, nearly $8 came from the public markets. That's still a pretty healthy ratio. Uber went public a handful of years ago. The ratio was 0.4. So over 99% of the working capital that produced the growth and the value of that business came from private markets. 40 cents on the dollar, came from public markets. That is a dramatic shift in value creation out of the public market and into the private market. So when we start looking at, we only look at interest rates, which is what really drove the flow of capital into public markets to begin with. Yes, that gap has started to narrow, but we've seen a dramatic shift of value creation and where growth can be found out of the public markets and into the private markets. Now, there are some other forces that are at work here. Some of it ties into some regulatory frameworks, projected forecasted changes. Equity is a big topic in our world today. When we start looking at the structures, and Dave alluded to it, who can participate in these products, the fact of the matter is these products in their current form today, by far and large, are only available to the wealthy. Eventually, something will happen in our regulatory framework that will open up these products to the full width of the wealth spectrum, which will just make more capital available to, at that point, I don't even know if you could call them the private and public markets, it'll just be the markets. But the point is, as capital formation is shifting to private, it's going to drag more asset and interest in privates with it, which is just going to amplify the percentage of growth equity that happens in the private markets. You know, this is seeking returns is the gravity of the boulder rolling down the hill. That gravity is going to continue to accelerate that rock going downhill, and that's what we're going to continue to see in the private space, is a continued interest in taking advantage and getting access to growth, which is not happening in the public markets.
I'm glad you brought up that dichotomy between the private capital raise and public capital raise. I mentioned this in my talk at the Speedway last year, but it bears repeating that I think it was 2020 where for the first time ever, capital raised in private placements and private transactions outstripped, was greater than IPO proceeds. And that was even more pronounced in 2021 and even more pronounced in 2022. And so there's a clear trend line in that regard. To me, that shows in part that there's increased confidence in the investor base in the private markets, in specifically in alternative investing. And I think you see that in a lot of the studies that were released last year during a bad market, a terrible market for most people's minds. And the confidence that investors and allocators had in a majority of the alternative investment categories, private equity, venture capital, and real estate, still held strong. And I think that that's hopefully going to continue. But along those lines, even with that confidence, from a structural perspective, Jason, you know, what kind of challenges are you seeing from a structural perspective in getting the investors to kind of understand and pull that trigger when it comes to the structural part of investing in alts?
So, Dave, I want to hit on one point that you just made, though, which is confidence in these types of products. There is a natural trade for returns in the private space, and it typically is at the expense of liquidity. Now, that is an expected trade, and it's a fair one to trade liquidity for an expected return. And you can see when you look at the average returns of these types of products compared with the public markets that they do outpace the public space. I think over the last 10 years, the average global large cap return has been around 10 or 11% or so. The dispersion of that return is about 2% from top quartile to bottom quartile. When you look at private equity, the average return over that same time frame, I believe, is around 27%, but the dispersion of return is nearly 30%. So confidence in the product, yes. However, it introduces a challenge that manager selection becomes paramount. Now, there is, depending on the type of manager you're talking about, and I'm only going to talk about private equity here, closed-end style funds by contrast with hedge funds. Because there is a strong correlation. We all know that past performance is not a predictor of future or guarantee of future returns. That's absolutely true. However, in closed-end products, there is a very strong correlation between managers that were top quartile have a 60% likelihood of staying top quartile going forward. Managers that are bottom quartile have a 60% likelihood of staying bottom quartile. And there's a one specific reason why that happens. In the world of private equity, when you're dealing with private company investments, it's all about access to deals and ability to negotiate deals. And this is where we see a dramatic difference with the types of managers that come across our channel. You can have the greatest ideas in the world, have insight into an industry. If you don't get invited to the table to participate in a deal, you can't build a portfolio that's gonna perform. So access to quality managers and being able to filter out those that are of lower quality is of terrible importance. The value, in addition to just being able to find access to the deals that certain logos can provide to a business, is also terribly important. $1 from Thoma Bravo or Sequoia is worth a lot more than $1 from Meritech. No offense to that firm, great firm. They're a couple hundred spots removed in kind of largest, most recognized brands in the space. What do the Thoma Bravos and the Sequoias do? There's brand value for being in the cap table of a company alone. In addition to the dollar, there's just value in having Sequoia listed as an equity partner. In addition to that, these firms that are just enormous bring terrific operating support advice to their portfolio companies as just part of being in the equity tables. And then in addition to that, the vast networks and what they can do to amplify the growth of a portfolio company is staggering. So this is why we emphasize so much in the world of closed-end private equity investing in particular. You have to be very, very careful about the manager you choose, because there's a high likelihood if you work with the wrong products, you will underperform public markets. Now, to your question, it had nothing to do with what you asked, but something maybe.
Keep going.
Anyways, structure.
You're on a roll.
So Dave mentioned typically these products are only available to qualified purchasers. So let's talk about this for a little bit, because what we're talking about is all private, non-registered product. Now there are four primary sets of regulatory and compliance. I would call it burden, but
I would too sometimes.
there you go. That these types of products seek to comply with, but avoid registration exemption. One of those typically says, for all intents and purposes, anybody below accredited investor can't even look at these types of products. That's not really the one that creates the most barriers of entry, though, for investors in these types of products. It's really the designation of the 3C1 to 3C7. So there are two different primary types of structures that these funds take. One is a 3C1, which says we can take smaller investors down to the accreditation level of accredited. And you can only take 100 of those. There's the 3C7, which says you can take, I'm going to say 2,000. I know it's 1,999, but I'm not going to be able to say that more than once. Up to 2,000 investors. But if you're going to do that, generally speaking, those investors have to be of a qualified purchaser status. Now, there are other ways that other members can participate in those funds. It's not worth even referencing how that works. Let's just say you've got to be worth a lot of money to participate in a 3C7 fund. Now, the Advisors Act has a provision in it that requires an investor that's in the fund has to be at least a qualified client, which is kind of right in between the accredited investor and the qualified purchaser, if that fund is going to charge a performance fee. Doesn't matter the details of all that. What it all nets out to is most of these funds are structured as 3C7s. Most of the investors in these funds have to be a qualified purchaser to satisfy all these rules because they want to charge performance fees and they want to let a lot of investors in. That removes the opportunity for participation in these funds from the vast majority of the people that are walking this planet. In addition to that, most of these funds, as they've grown, they've had success, they have found that it's not worth their time dealing with even a small qualified purchaser. Somebody who can maybe write at the low end of qualified purchaser suitability, maybe $150,000, $200,000 for an individual name. And I'll come back to that in a minute. That's probably the max. These fund sponsors don't want to deal with somebody who's writing a $150,000 check. Some of the funds that we're dealing with that we see that are really the name brand reputable firms, top quartile, going to stay top quartile for all the reasons we already discussed, they're setting minimums at $10 million and above per investor. I mean, you tell me what kind of net worth you have to write a $10 million check. And I'm going to exaggerate that. I'm not even going to exaggerate. I'm going to go one up on that. These are closed-end structures that are drawdowns. You're going to commit capital. They're going to call capital and invest for a couple of years. Then those investments are going to mature and then they're going to exit. You're never going to actually meet your peak committed exposure into one of these funds over the entire life of the product. At most, you'll get about to 80% of what you've committed to a fund actually invested in that fund, and it's only for a couple of years, over a 10-year life of these funds. So if I'm an investor and I want to get, let's say I'm worth $5 million, right? And at that level, we see about 25%, 30% of that is going to be committed to a private equity portfolio. So somebody do the math for me. Let's call it $1.5 million. If I got $1.5 million I can put into private equity funds. Well, first of all, I can't because they want $10 million. But even let's say I can invest at some lower level. How many funds would I actually need to get a mature portfolio? Again, a 10-year life of a fund, you're really only at peak exposure to that fund for maybe 2 years or so. Rough math says that I need probably 5 of those funds stacked up. This is what's called vintaging, to where I can get a blended level, we call it a mature portfolio. After you've rolled in those 5 funds, now you have a mature portfolio in, mind you, one strategy that will sustain a level of your portfolio against a target. So we said, what did I say, just 5 funds there? We said $1.5 million. That to me says that we can have, $300,000 bite sizes. Now this is one strategy. We're just talking about trying to get private equity growth. We're not talking about exposure to venture. We're not talking about real assets. We're not talking about infrastructure. These are all additional tranches that take that $300,000, and I don't know if there are 5 of them, let's say there are 3 of them so I can do the math. We're going to say that we're going to go into this space with $100,000 bite sizes. The minimums of these funds are $10 million. You start to connect all the dots, and I'm sure none of my math actually worked there, but you have to be worth probably $75 million as an individual to actually have, as an individual, to have a mature portfolio of private equity vehicles that you're investing in direct. Now, that's not $75 million as a family, or that's $75 million as an investing entity. That's measured at the trust. That's not the individual, that's measured at the trust. Dave, how many trusts do you have in your family office? Probably 4 or 5, I don't know. Doesn't matter. The point is, all of these are multiplying factor. I was going to say multiplicating. Multiplying factor, I'm excited. These are multiplying factors on how much net worth an individual needs to have to access this space. So when we talk about structural challenges, these are just the rules that are in place that allow people to even think about participating in these products. Now let's take those 5 different tranches with the 5 different vintages to build up a mature portfolio that's, I think, 25 products, if my math holds. The transacting process to invest in one of these funds, we're all used to going out and our 76-to-1 public to private ratio favor at Google. We're all used to going out to, our brokerage system saying, give me $1,000 of this. I don't even know what it's worth anymore or what that would translate into real dollars. Go, done. Shows up in my portfolio, settles a couple days later. That's a different topic, why we still have 2-day settlements in this world. Totally off topic.
It's down to 1 now.
Well,
Yeah.
anyway, so the point being, it's immediate, right? I've got cash in my portfolio, I hit go, I'm done. To invest in a private investment transaction, it's generally evidenced through what's called a subscription document, which is typically about a 30-page or so document that comes along with about 500 pages of disclosures. Let's pretend we have fantastically capable and high-paid counsel on staff
And
to
you'll
read
never
our...
get sued when you give your investors those 500 pages, right?
Exactly, that's right, because they're disclosures and they matter. Let's pretend that we paid somebody to read those for us. We still then have to go through 150, did I do my math right? No, it's 20, it's not 5, it's 25 times 30, whatever that is. Somebody do that math, I don't have my phone out. That's a lot of pages to get through. Every one of them requires, give me a current utility bill. How many times have you had to go to your trash to say, when was the last time I got a utility bill? Was it in the last week? Because if not, it's already been out to the trash bin to try to find a utility bill to prove that you are who you are, to go along with a copy of your driver's license. It's not complicated, but it's terribly burdensome. Advisors can't stand it. Investors can't deal with it. And when you multiply that process times 25, even if you could get into the fund, it's unworkable for most advisors. The structures, while they've matured, there are better rules and regulations, controls in the industry. The fact of the matter is, it's an unapproachable space for the vast, vast majority of every investor that's out there. Now, there are ways that feeder funds can be created to start to reduce the minimums, to make them more approachable. In most of the ways that it's been done in the past, it doesn't really solve many problems outside of getting the investor to lower minimums. It hasn't been done in a way, I'm trying not to make this self-serving, but for the most, it hasn't been done in a way that reduces the total number of times somebody has to go through a subscription process. All of these are barriers to really allowing the vast majority of the public to participate in where all of the growth is happening in the world of equity.
Is that where you're seeing the biggest challenge? Just a follow-up. The challenge to getting investors into the alt investment space. Is it a matter of education, understanding the asset classes, or is it more a challenge of the subscription process and understanding how that actually works? Or is it something else? And one of the biggest benefits that I've seen over the last 20 plus years during my career has been, I hate to use buzzwords, but it's really a democratization of investing platforms. It's so much easier to invest in certainly the public markets now than it was even 10 years ago, and certainly 20 years ago. I can remember trying to get allocated IPOs during the .com era, and it was a bear. Now it's much, much easier. And so it's been the advent of platforms and fintech really to make access to all types of investing easier. So is the challenge education, access, or something else? And how does Proteus help in that regard, or how does Proteus address those challenges?
So education is part of it, but we talked about just a moment ago the structural complexity of these products. The challenge of them goes far beyond just the structure. When we talked earlier about the opportunity for outsized returns, but with that comes the dispersion of returns. The first issue is finding the right managers. Now, there have been a lot of advancements and there are ways that firms can actually market these days. A long time ago, they couldn't market at all, which made it even harder. But now there's some marketing. But the problem is, understanding the universe of what's out there when there's a dramatic subset, and which happens to be the best managers don't want to be out there. You know, there was, gosh, I can't remember the name of the firm. It was one of the top 40 private equity firms in the world. You go to their website, it has their name, and that's it. Doesn't even have contact information. Doesn't even tell you where their offices are. Just has a name. So purposefully making it difficult to even get in touch to talk with them. So understanding what all the offerings are that are out there, and even if we say we like Thoma Bravo is not always raising. So when are products coming to market? So you have to know what are all the names that you're interested in across all the different macro asset classes and strategies. You have to know their product schedule. You have to then, when you find a product, do due diligence that product. So let's pretend we actually know what we want to invest in, which for even the largest of the firms is challenging, given the number of products that are constantly released, made available. Getting through due diligence of a product, these are still private investment transactions. They are analogous to investing in an operating business in a lot of ways, because they are in turn investing in operating businesses. So you have to look at that investment as though you are investing in a business. You have to look at all the key personnel. You have to do background checks on all the key personnel. You have to look at service providers. You have to look at churn in service providers. Really easy to see what audit. We just had a fund recently on our platform that changed auditors. That's kind of a big deal. Maybe it isn't. A lot of these firms actually write into their documents that they are forced to change auditors after certain time periods. These are all the things that you have to, as an investor, understand and get under the skin of with these offerings to make sure that it's a reputable firm, that the key personnel, let's take key personnel, we talked about that earlier. That's one of the key driving factors in private equity that makes these firms be able to stay top quartile or stay bottom quartile. It has a lot to do with the names and the faces and the relationships that they have in the market to be able to get deals brought to them. You have churn in management at a private equity firm. That's a big indicator that there's risk in that next vintage, that they may not get access to the same deals in whatever vertical or sector that partner was operating in. These are the things that go into due diligence. And a dramatic level of due diligence. When we, and Eric can talk about this more coming up, when we do due diligence on a product, the result is a 50-page report on that fund. That's not on Thoma Bravo, that's on Thoma Bravo, I don't even know what vintage they're on. That's not on CD&R, that's on CD&R 12. When 13 comes, you do it all over again. So identifying all the manager landscape, knowing what are the managers you want to be looking for, understanding the product release schedule for those managers, getting through due diligence. The next step is that subscription document process that we talked about that I butchered my math on, but I got the point across. We have just gotten into a fund now. That's what it takes to get into the fund. The burden, one of the more dramatic burdens, actually happens after we've got in the fund. We're like, all right, we're in, right? We made our investment into our 25 products. Now, all those 25 products on random schedules, sometimes multiple times per month, are going to be sending you a letter saying, hey, Jack, I need $15,000 of your investment. 25 letters every month you're going to get. Hey, I'm ready for more capital. I'm ready for more capital. That's happening. Every one of the funds that you're dealing with is doing that on a constant basis as they are finding investments to invest in. Now, the upside to that is that when Jack, our sample investor here, decided he's going to put $1 million into a product, he doesn't have to write that check day one. They don't take that capital because they are out looking for operating businesses to invest in. So Jack doesn't experience a performance drag. He's still, well, he's investing in his cash. He's, of course, as a good steward of his commitment, making sure it's liquid and available. But he is having to respond to all these capital calls as they're coming along. And guess what? As Sequoia is calling, they're also sending money back because they're equalizing new investors in. The cash flow burden associated with closed-end products is insane when you amplify the number of products you need to have in a portfolio. So we already invested on all these. Now we've got to manage all these cash flow burdens in addition to making sure across our entire portfolio, we've got a view as to how we expect these funds to be asking for capital, how we expect them to be returning capital, so that we as an investor don't find ourselves in a liquidity pinch. This is all post-transaction portfolio management, and that even isn't addressing what happens at the end of the year, when Jack is going to receive 25 K1s, usually around August 30th, maybe a little bit later. So the burdens go far beyond just the structural constraints. It's the ability for any firm of any size to even understand what's out there and available, to somehow rank them, understand them, diligence them, invest in them, and then manage the ongoing portfolio management burden.
Yeah, that's a great point. And with that in mind, I know we're running up against time with the next panel, but I did want to ask this question just on outlook. You know, what's your feel, what's your sense of the outlook for the alt investment space from a high level, and maybe drill down into particular asset classes that in this environment with, you know, hopefully a terminal rate structure coming up within the next quarter and a half from the Fed, what's your general outlook for alt investments and the asset classes for the balance of 23?
So Eric, and I think Eric and the panel he's on is going to talk about this a little bit more in the next session, but we see a lot of interest in private credit right now. That's no big surprise. I mean, look, the trade in the world of private investments is higher returns. In the world of private credit, it's higher yields. Lots of different slices and dices in the world of credit, as we all know. They've all got their own risk and performance characteristics.
Is it too late for private credit?
No, it's not, and I'm going to tell you why.
I don't want to steal Eric's thunder.
I know, we're taking the next session. It's not too late for private credit for a couple of reasons. Number one, most of the private credit instruments that are out there use floating rate underlying investments, which means they've been able to respond and perform a lot more quickly as rates have gone up. Now, we do view this as a short-term opportunity, because if rates either stabilize or they start coming back down, those floating rate instruments are also going to adjust on the back end. What that means is that if you're going to do something in the private credit space, two things. Number one, understanding the duration of the instruments in the product is paramount, and if they're biased towards floating or fixed rate. Long duration, fixed rate instruments that are raising assets and investing now is not such a bad thing. However, and again, not to get too down into views on the economy, we still don't feel that like we have seen the effect on jobs from the macro economy that we're working in right now, which means we are staying clear of things that are not collateralized. We're staying clear of direct lending and consumer-oriented private credit products. Collateralized debt doesn't solve the problem of defaults, but it provides a backstop and an asset to rely on in the event that we do start experiencing significant defaults, which is a real risk out there. Now, that's more short-term opportunity. What we see longer term, I mean, nobody gets projections on the market, right? So I'm not going to even pretend to, but we all know there's uncertainty. There's always uncertainty. There's a ton of it now. We feel like there's a bias to flat or down in the public markets, which generally is going to say, if you're looking at hedge fund structures, which we've been talking all about closed-end private equity structures, we haven't really talked at all about hedge funds. Hedge funds are typically more oriented towards using liquid-style investments, so they tend to be more correlated to the public markets, depending on their strategy. An absolute return type of a product might not be bad if we have little confidence or certainty in the markets going forward in the open-end structures. Closed-end structures, this is a fantastic opportunity. Vintages from a year or two ago, they'll still perform well, but they're probably going to see a bit of a drag because their investment cycle was in a very hot market. Now, these are private deals, but the public multiples have it's not a linear or a one-to-one effect, but they have a dramatic effect on private multiples. So public markets being hot will produce hot private deals. It's just the way it works. So vintages that we're investing over the last 2 years or so may see some drag on their returns at the end of their life 10 years from now. Vintages that are investing right now have a fantastic opportunity because they can translate the uncertainty, volatility, chaos, and fear in the public markets to drive lower private market multiples and structure deals that have a chance to outperform 10 years from now. Now, a topic that didn't get brought up but has to be at least seeded for other people to go do their own research is valuations of private funds it's an important topic. I would say one thing on that right now, which is if closed-end private equity growth-oriented funds are investing right now, we all know and advocate within our client base that we don't look at what happens on the stock price tomorrow. Take a long view. It doesn't matter if the portfolio companies of that private equity fund are marked down next quarter because we saw public market multiples come down. It doesn't matter because that instrument, A, can't be sold tomorrow. It's not liquid. B, is expected to be in that portfolio for 10 to 15 years. That gives private equity sponsors a tremendous amount of control in waiting for market conditions to recover to be favorable for exit. That's why private equity funds over the long term can outperform because they can wait for 5 years. If they see an immediate exit, they'll take it. If they don't, they'll wait. And that then starts to introduce the topic of the value of marking to market portfolio holdings and whether or not it even matters if the value reported on your NAV from a private equity portfolio is accurate or not. I get the denominator effect stuff. I get the sector concentration stuff. But the fact of the matter is, as it relates to the management of that portfolio, it does not matter. You can't get out of it anyways.
Which is a perfect segue into the next panel. But sorry for going over a little bit, but it's really important.
I've got a couple more things I want to yell about.
That's what I was. It's really important to hear insights from. It's really important to hear insights from guys like Jason and with his background, and now with Eric and the next panel. But we really appreciate you listening to our back and forth, and hope you got some good trend lines out of it, some insights. And we're available for questions afterwards as well. And we'll bring up the next panel. So thank you very much.